Hello everyone, I'm Josh Garrett, and in this video, I'm going to be talking about the fees and expenses of a mutual fund. Now, in the first video I made on mutual funds, I talked about the basics of mutual funds, like what they are, what's an active and passive fund, and what is the advantages and disadvantages of investing in a mutual fund. In this video, I'm going to be talking about simply the fees and expenses and their impact on the returns. Anyway, let's first go on to understanding the costs and expenses. Mutual fund fees and expenses are what you pay to operate and manage the funds. These costs are crucial in assessing a mutual fund's investment quality, as they significantly impact shareholder returns. Generally, passive funds have lower expenses than actively managed ones. Running a mutual fund incurs various costs. These include fees for buying, selling, or exchanging shares, shareholder fees, ongoing operating costs, and investment advisory fees. The latter covers managing the fund's holding, marketing, distribution, custodial services, transfer agency, legal, accounting, and administrative expenses. Some funds charge fees directly at transaction time to cover transaction and account costs. Regular operating expenses are paid from the fund's asset or indirectly by the shareholders. The board of directors oversee the fund management and operations. They minimize the costs and protect shareholders' interest. One key duty is negotiating and reviewing the advisory contract, which includes the fees and expense ratios. The expense ratio measures the portion of fund assets spent on administration and operations. Now, what is the impact of these costs and expenses? So, funds with higher costs must outperform those with lower costs to generate the same returns. Even small fee differences can accumulate, leading to substantial impacts over time. Higher fees and expenses means less money in your investment portfolio. So it's always important to ask that if a mutual fund has high expenses, will it also outperform the mutual funds with lower expenses? Let's go to the types of fees and expenses. First of all, you have sales load. Sales load expenses can be divided into two parts: the front end load and the back end load. The front end load is a fee charged when you buy shares in a mutual fund, usually a percentage of your investment. For example, a 3% front-end load on a $10,000 investment means paying $300 in fees, with $9,700 going into the fund. Back-end load, however, is known as contingent deferred sales charge. This fee is paid when you sell shares. It decreases over time to encourage long-term holding. For instance, it might start at 5% if you sell within the first year and decrease to 0% after 5 years. Second, we have redemption fee. This fee is charged when you sell or redeem mutual fund shares. This flat rate fee discourages short-term trading. For example, a 2% redemption fee may apply if the shares are sold within 90 days of purchase. Then we have exchange fee. It's a fee for switching shares from one fund to another within the same fund family, covering the exchange administrative costs. Let's say I'm investing in a certain company's flexi cap fund. They might also have other caps like large cap, small cap, and mid cap. So if I'm switching from flexi cap to mid cap, then I might have to pay an exchange fee. Then finally, we have an account fee. It's an annual fee to maintain your investment account, covering various administrative costs. This can be a flat rate or a percentage of your account balance, such as a $50 annual fee. In conclusion, Understanding and managing mutual fund fees and expenses is essential for maximizing investment returns. By keeping an eye on these costs, you can make more informed investment decisions and potentially enhance your portfolio's performance. I really hope this video helped you, and if you like this video, please like and subscribe. Bye.